I have the honor and the pleasure to moderate another panel here, and I will have a panel afterwards with some of our UBS specialists for investing. At this time, we have specialists here on monetary policy, eminent policymakers, all three of them. Let me start by briefly introducing the panelists. The first speaker will be Eric Rosengreen. He has been the president of the Federal Reserve Bank of Boston since 2007. He joined the Federal Reserve Bank already in 1985, and he worked both in research and banking supervision. Eric Rosengreen is an academic I know for many years quite well. So Eric, welcome to the bank and thanks for doing this. He's published extensively on macroeconomic and international banking, on banking supervision, on risk management. He has a PhD of the University of Wisconsin, and it's a pleasure, Eric, to have you here. The second panelist is Klaas Knot. He's been the president of the Dutch Central Bank since 2011. In his capacity as Dutch Central Bank president, he also serves as a member of the Governing Council of the ECB and on the Board of Governors of the IMF. He's also the vice chair of the FSB, and in that role really leads also not just monetary policy, but global regulation. He is a professor at the University of Amsterdam and an honorary professor of the University of Groningen, where he received his doctorate. And prior to being president at the Dutch Netherlands Bank, Klaas has been the Deputy Treasurer General and Director for Financial Markets at the Dutch Ministry of Finance. Klaas, always a pleasure to have you at these conferences, and thanks for being back. The third panelist is Tobias Adrian. He's the Financial Counselor and Director for Monetary Policy and Capital Markets at the Department of the IMF. Prior to joining the IMF, Tobias was the Senior Vice President of the Federal Reserve Bank of New York. Tobias Adrian has taught at Princeton University and New York University and has published extensively in economics and finance journals. He holds a PhD from the MIT. So Tobias, thank you for also joining us here. The idea is that the three will give a short presentation in starting up, and then I will come with some moderated and questions to all of them. The general topic is monetary policy and the difficulty that we're in. So Eric, let me pass over to you. And I understand that, Eric, you have a few slides which have been made available and will be shown.
Thank you very much, Axel. Thank you for having us. It's a wonderful panel. These slides are available on the Federal Reserve Bank of Boston website, and you can also see the written text. I'm going to go through the slides relatively quickly, but you can see a more comprehensive discussion in that text. Next slide, please. So we've had some good news on the economy in the United States, at least. The unemployment rate dropped by a percentage point and was down to 6.9%. But as we're all aware, both the United States and Europe are in the midst of a second wave of the pandemic. That provides a lot of uncertainty as to what the outlook will actually be until we do have a vaccine. The good news is it does look like there are vaccines that are likely to be more effective than many people anticipated. So at some point, we're likely to have a relatively robust recovery. Unfortunately, we have to get there. And in order to get there, different countries are taking different approaches. In Europe, you've had a shutdown light model. In the United States, we've had very divergent reactions depending on which state you're in. It's been a very decentralized approach. In parts of the United States, we have infection rates that are much higher than in many places in Europe. And unfortunately, many of those states are doing very little. But despite the lack of government mandates, individuals in the end have the choice of what kind of behaviors they want to take with wearing masks and going outside. And so even where there are not government mandates, there's obviously the potential for the economy to be disrupted because people choose not to participate actively in the economy. I would say that aggressive monetary and fiscal policy, both in the United States and Europe, have been very supportive of the economy to date. But in the end, this is a public health policy breakdown, and the solutions are going to have to be with the public health outcomes. Next slide, please. the pandemic arguably is a tail event. So a tail event is normally something that is a severe outcome that was unexpected. You might say that pandemics were not tail events because people were forecasting that pandemics would occur, but we certainly couldn't forecast exactly when they would occur and how severe they would be. And unfortunately, we are seeing that it can be a very disruptive force in a global economy. How severe the pandemic is and the economic consequences depend in part on the willingness of monetary and fiscal policy to respond, but also in part how fragile economies were going into the problems. And so both households, financial institutions, and firms, how levered they are, what kind of liquidity positions they had going into the recession is critical for the outcome. So what I'm going to be talking about today is how fragile conditions can amplify the economic problems. And those economies that have taken precautions prior to the pandemic are less likely to have the amplification, and those economies that haven't are likely to be more disrupted. Next slide, please. It's particularly important when we're thinking about new monetary policy frameworks. In the United States, we have announced a new framework. That framework is designed to maintain current low level of interest rates, which has our short-term interest rate between 0 and 25 basis points until we've achieved 2% sustainable inflation. That's a very different policy than what we followed in previous recoveries. It implies a much slower raising of interest rates. And while I'm very supportive of very low interest rates, given the economic conditions we have, I think we have to be cautious in terms of thinking about what the implications are. And in particular, I would highlight that if we keep rates too low for too long, there are risks that happen in both the household sector and the firm sector that can make the next recession an even worse outcome. Next slide, please. So overall, in the United States in particular, we don't have the financial stability focus that many other countries have. We do have supervisory tools. We have not been as proactive in the United States to address it. Many European countries activated their CCYB well in advance of the pandemic. In the United States, unfortunately, we did not. I would also say in the United States, we focused more on too big to fail than we did on financial stability. And that means that we don't have the governance and we don't have the tools that many European countries have. That's a real challenge because if you really want to keep rates low for a long time, those financial stability guardrails are really important. Next slide, please. This first slide just highlights, I think, what probably everybody on this Zoom call is quite aware of. So on the x-axis, it shows the share of a country's global population. On the y-axis, it shows the share of deaths due to COVID-19. I had to do this as two panels, in part because the United States is off the chart on deaths. So you want to be below the dotted line, and unfortunately, the United States is a positive outlier on this chart. I would highlight, unfortunately, we're not alone. There's some European countries, they're not nearly as extreme, but if you look on the right side, the UK, Italy, France, and Spain are a cluster that also are well above that dotted line. Given that this is a UBS conference, I would highlight that Switzerland is actually relatively low compared to those other countries, which is a positive thing. Next slide, please. All developed economies tend to have more of a focus on services than goods. And so this is a virus that affects the economy that particularly large exposure to services. The United States has extensive services, and unfortunately, many of those services require personal interaction, and it's harder to socially distance than you can in a factory setting. So this just highlights that from 2019 Q4, goods are actually in the United States, the consumption of goods is above where we were at the beginning of the year, but services lag. And as you would expect, the services that have lagged have been things like transportation, hotels, restaurants, and retail. Next slide, please. So the pandemic has disproportionately impacted developed countries in part because of their dependence on the service sector. Countries are at various stages of controlling the pandemic. But I would say, unfortunately, all countries are not where we wanted to be at this stage, at least I would say in Europe and the United States. Next slide, please. So one of the challenges is to think about, for monetary policy, how low do we push the economy and how much do we risk getting imbalances in the economy? And what this chart shows is, if you look at the amplitude of this recession in the United States, it's much higher than previous recessions. Obviously, shutdowns are economically very costly. I would also highlight, though, that the blue shaded area, which is the part that we're above full employment, tends to be much larger than the periods where we have the green shading, which is where we're below our unemployment rate. The inflation and inflation patterns accounted for much of the movement prior to 1985, but more recently, financial stability has been much more critical. I would also highlight the slope of the recovery and how long the recovery takes is very much tied to what fiscal and monetary policy reactions we have. Next slide, please. Monetary policy in the United States has been very proactive. I thought we were fairly proactive in 2007 and 2008, but when the one advantage of a pandemic is it's very clear that you have a problem when you have a problem. So in March, it was very clear that the pandemic was becoming a real problem in the United States. There was widespread shutdowns, market disruption was very obvious. We dropped our federal funds rate down to 0. And next slide, please. We also started asset purchase program, and we also created a variety of facilities. Those facilities were intended to make sure that primarily the firm sector was able to continue to get financing at appropriate interest rates. So it really was a substantial monetary policy reaction. I would also say that fiscal policy was much more proactive than it has been in the past. And that has been one of the reasons why the effects to date have been more mitigated. Next slide, please. So the initial response, I think, was quite good. But I want to highlight in this talk that imbalances have probably made the shock worse than it otherwise would have been. Next slide, please. And I'm really going to focus on the firm sector. So if you go back to 2007, 2000, that were the cornerstone of the problems. But the United States went into this pandemic with a highly levered corporate sector. This just shows you some of the service sectors that have been very severely impacted. And you can see that the payroll employment, which declined fairly significantly in things like food services and retail trade in the 2007-2008 recession, are nothing compared to the kind of impact that we've had in this recession. Next slide, please. Now, this chart just highlights the bankruptcy of people in the consumer discretionary sector. And what I want to highlight here is, one, not surprisingly, retail and consumer durables are sectors that you would have expected to potentially be affected, and they certainly were. The second thing, though, I would highlight is how many employees they had on the far corner and the debt to EBITDA in the end of 2019. So this is just a measure of the capacity to have enough income to pay off your debt. The Boston Fed runs the Main Street facility. In the Main Street facility, we have cutoffs for what the debt to EBITDA for troubled borrowers can be. If it's a loan that is collateralized, you can't have a debt to EBITDA above 6. If it's uncollateralized, it can't be above 4. You can see that many firms that ended up declaring bankruptcy actually had very high leverage. And we're not seeing all firms fail. We're seeing firms that were particularly levered going into this recession fail. Next slide, please. This just shows you that they didn't fail just in the last couple of quarters because they had just taken on the debt. So this compares the firms that are in that consumer discretionary sector in 2020 that defaulted with those that have not defaulted, at least to date. I think what's important to look at is in 2010, they had debt to EBITDA ratios that were roughly equivalent, but you can see that the debt to EBITDA diverged, and the ones that ended up declaring bankruptcies had much more a debt to income. And I would highlight that one of the reasons you see that sharp increase on the defaulted firms at the end is not just that they were taking on more debt, but that their income was already going down going into the pandemic. Next slide, please. One of the challenges with debt to EBITDA is a low income. So this just shows it in another way. This is the median EBITDA to interest expense ratio. You can see that starting in 2014, the more leveraged firms, even though interest rates were quite low, nonetheless were having problems meeting their interest expense ratio. Next slide, please. The final slide in this group is showing the median debt to asset ratio. Again, you can see back to 2010, the defaulted, non-defaulted firms were in roughly the same position, but the firms that defaulted in 2020 gradually were increasing their debt over the entire period. Next slide, please. So excessive risk taking is particularly problematic when you get a tail event. This is just some anecdotal evidence, but I think we need to do much more work understanding how leverage impacted bankruptcy in this recession and what kind of risk-taking behavior occurred. And the final set of slides are going to just highlight that if the only people impacted were shareholders, we might not care. But when a firm declares bankruptcy, customers, suppliers, and particularly employees are affected. And I'm really going to focus on employees in this last set of slides. Next slide, please. This just looks at which sectors of the labor market are disproportionately represented in services. So just as an example, looking at the column of services and looking at women, the service sector disproportionately has women. So it says what percentage of women are in services relative to the percentage of women in the labor force. A number greater than 1 indicates an overrepresentation. A number under 1 represents underrepresentation. Looking at leisure and hospitality, which is a sector that has been particularly hit, you can see that women, African Americans, Hispanics, and workers 16 to 24 are overrepresented. So the sectors that are being hit quite hard are sectors that also have some of the people that are most disadvantaged in the labor market. Next slide, please. This shows what happens with labor force participation. I would just highlight that this has not only affected women because they are disproportionately represented in some of the sectors that have been impacted, they're also more impacted because they're more likely to pull out of the labor force in order to be able to take care of their children. In the United States, many of the schools have shut down. When you have children at home and they're doing schools online, you need somebody to supervise them, difficult to get childcare. And this potentially is a problem in the longer run if women are more permanently, if this pandemic lasts long enough that women decide that they're permanently going to stay out of the workforce, that's a real problem for what the economy is going to look like going forward. Next slide, please. The same thing's true for African Americans and Latinos, just highlighting again, they may be more likely to be permanently out of the labor force as a result of this disruption. Next slide, please. So the pandemic has disproportionately affected vulnerable populations. So to the extent that firms chose to have excessive leverage going into this recession and nothing was done in supervision or financial stability, they are the ones that are disproportionately bearing the cost of those decisions. Next slide, please. Concluding observations, shocks happen. There's nothing we could have done probably to avoid the pandemic, but we could have done things to make the impact less severe. One of the things that we did was monetary and fiscal response is an important mitigant, but excessive risk-taking before the shock occurred is likely to prolong the economic distress that we are facing right now. Next slide, please. So the policy implications in the United States, I'd say we're not that well equipped to deal with financial imbalances. We lack the governance of many European and Asian countries. We also lack the tools that many European and Asian countries have. So easy monetary policy requires guardrails. I think this is appropriate time to have easy monetary policy. We're obviously in the midst of a very serious pandemic, but it's important to make sure those guardrails are appropriate to make sure the severity is not worse. Thank you, and that concludes my remarks.
Thank you, Eric. And I think there's really a rich number of things we'll go back to in the discussion. But in order to keep to the agreed protocol, let me bring in Klaas, who I would ask to portray his view from a European side, and then we'll move to Tobias and then exchange views. So Klaus, floor is yours, please.
Thank you, Axel, and thanks for having me on this conference again, this time unfortunately in virtual format. I want to start by the observation that for many of us, this is actually the second global crisis, and here in Europe, you could say even the third major crisis in less than a generation. And that is already taking place at a time in which there are very important developments that have been changing the macroeconomic, the financial, and the policy landscape. If you think about our global economy, we have witnessed a falling natural rate of interest. We've witnessed lower trend inflation, further globalization, further technological progress. In the financial area, we've seen higher and higher debt levels and leverage, a large role for central banks in financial markets and financial intermediation, and a high demand for safe assets. And on the policy fronts, the past years were marked by non-standard monetary policies, by macro-prudential policies, and actually, as also indicated by Eric, this time around an active rather than a passive fiscal policy. Now, in the first wave of the corona crisis, the main economic consequence, of course, was a sharp fall in output, together with the threat of a major liquidity crunch and financial amplification effects that could have taken place from it. Consumer attitudes, and particularly their spending behavior, also changed quite drastically. But I would say that we've been able to avert a full-fledged crisis by a decisive fiscal, monetary, and regulatory response. The fiscal support, I think, was unprecedented in the post-war era. It helped keeping firms solvent, workers protected. And in Europe, I think it was noteworthy that this was not only delivered by a national response, but also by what I would call the landmark Next Generation EU Recovery Fund. With very accommodative monetary policy, we were able to prevent a major liquidity crunch and financial amplification. Monetary policy entered the corona crisis already being quite stretched, I think, in many advanced economies. Policy rates were already at, or at least close to, their effective lower bound, and central banks had taken a large role in financial markets and financial intermediation. Against that backdrop, the ECB's response to the pandemic had a dual aim. First and foremost, protecting the monetary policy transmission mechanism by containing spreads and containing risk premia. And second, mitigating the economic impact for the euro area of the outbreak and escalating diffusion of the coronavirus. And in that context, it was the Pandemic Emergency Purchase Program that was the most obvious response to the crisis so far. And it was complemented by the well-known TLTROs and PELTROs to ensure also bank credit flow. And last but not least, regulatory constraints were also temporarily eased to allow banks to provide additional funding to firms and households that were in need. However, the events of the past few weeks have shown that the virus is clearly still among us, and that in spite of all our efforts, a second wave has not been avoided. And going forward, economic activity will now likely be subject to a very bumpy trajectory until the availability of the vaccine paves the way for a recovery in output and inflation to take hold more convincingly. Yesterday's news confirms that we can be hopeful that there will indeed be an end to this pandemic emergency as medical solutions are being developed successfully. But at the same time, the deployment and the widespread availability of the vaccine will continue to create uncertainty, and it will imply that the specter of potential future containment measures may weigh on economic activity into 2021. The outlook will then be shaped by different factors, which may pull it in different directions. On the one hand, activity has rebounded much more strongly in the third quarter than was expected. And this confirms that idle resources can resume economic activity much faster when no longer constrained by containment measures, which will also support the medium-term inflation outlook. Moreover, households and firms seem to adapt better to the pandemic and the containment measures, which arguably makes activity also more resilient. But on the other hand, as I said, as the pandemic is drawn out into 2021, the financial situation of firms will become more vulnerable. And this raises the risks of financial amplification of the corona shock, with liquidity problems morphing into solvency problems that then affect bank resilience. Such mechanisms were very manifest during the global financial crisis a decade ago, and any reoccurrence might therefore also raise some legitimate questions about the adequacy of financial reforms implemented since. Based on our December round of projections, we will then have to come to an assessment which of these forces will more likely prevail. Now, let me end by drawing what I see as 4 main lessons from these major crises that we've lived through over the last 13 years. And the first lesson, in my view, is that policy responses need to be holistic. And in the heat of the battle, I think it's the right mix of fiscal, monetary, and financial policies that is required. All policies need to play their part, and interactions between them are also very important, as was the case in previous crises as well. The second lesson is that within this holistic approach, fiscal policy must be in the lead in order to minimize scarring of our production capacity. It is important that the fiscal support is not withdrawn prematurely, but rather that it remains geared towards supporting ailing businesses. It may even have to be scaled up to buffer the effect of the renewed containment measures. Timely and correct use of the next generation EU recovery package can and will play an important role in this respect as well. The third lesson is that monetary authorities have to stand ready to act and contribute to tackling any escalation of the corona crisis. But beyond that, there are limits to what monetary policy can achieve. With renewed fears about a resurgent corona pandemic, and also renewed restrictions imposed to contain it, aggregate demand is inelastic with respect to financing conditions. And in such a situation, it would seem more fruitful to directly focus on these financing conditions to ensure that demand can display its full elasticity once no longer constrained by the virus. The best that monetary policy can then do in support of the economic outlook is to continue to neutralize the tightening effect that the pandemic would otherwise have on the highly accommodative financial conditions that were already in place pre-corona. Now, we have announced that at our December meeting, we will recalibrate our monetary instruments, and that will then also have to include a reflection on the efficiency of the use of these instruments with a view to providing effective support for the euro area economy. The fourth and last lesson, and which I think should definitely not be forgotten, is that the post-crisis recovery phase in the euro area, growth-enhancing structural reforms will be key because they attack the problems at their roots. It is inevitable that fiscal spending will raise public deficits and public debts substantially, and I would add in an unprecedented fashion for a peacetime period. That will mean additional burdens on future generations, and future generations can only bear and redress such debt burdens if simultaneously structural measures will be taken to protect the public investments that are needed to boost productivity growth. And with this, let me conclude.
Thank you. Number of issues will come back, so thank you very much for those views. Let's pass over then to Tobias, please.
Yeah, thanks very much. Thanks for having me. Klaas and Eric have covered a lot of issues already. I will take a little bit of a broader global view on the monetary policy questions. I think one of the positive outcomes of this year is that we have seen the policy response working in the sense that the adverse macro-financial feedback loops that were so prevalent in the 2008 crisis have been arrested by aggressive policy response. So when we look around the world at the monetary policy, we see, of course, that conventional monetary policy by lowering interest rates, short-term interest rates, has been very broadly triggered, both in advanced economies and emerging markets. And so in many advanced economies now, interest rates are either at or below zero. Some are a little bit above zero, but many advanced economies are extremely close to the zero lower bound. Emerging markets also lowered interest rates very broadly because, of course, this crisis came with a collapse of demand and the downward pressure in prices, in both commodity prices and many other prices. So that allowed conventional policy to be eased. In addition to that, unconventional monetary policy has been deployed around advanced economies as well as in emerging markets for the first time. So, for example, in many countries, the increase of balance sheet size of the central banks have been of the order of 10 to 15%. So these are very large increases in only 6 months. And even emerging markets have increased balance sheet size quite dramatically. The outcome of that is that financial conditions have eased, i.e. asset prices have rebounded very strongly, right? As Klaas mentioned, there was a sharp sell-off in March, and that sell-off was disorderly in some segments of the market. And so central banks came in a concerted effort, very aggressively, to ease financial conditions, to ensure market functioning, but also to get asset prices back up. And indeed, in some countries, we now see that equity indices are above levels of January. And global financial conditions are very favorable. Issuers, both sovereign issuers as well as corporate issuers in investment grade, on average, can issue at lower yields today than they issued back in January, right? Of course, for some of the riskier borrowers, sub-investment grade, emerging markets, or some high yield segments for the corporates, you do see that yields are higher than in January, but still even some sub-investment grade issuers have issued since the crisis began. So the easiness of financial conditions has helped economies domestically, but also broadly economies around the world. And that is tremendously helpful. At the same time, of course, the banking system went into this crisis with very healthy capital levels. So regulators have used the 10 years since the global financial crisis to reform capital and liquidity at the banks. And so for the first time, the IMF in October published a global stress test where we looked at about 350 banks around 29 economies of the world. And we asked what would be the level of capital for the global banking system under a severe stress scenario where the pandemic is prolonged and output is not rebounding. And we found that globally the banking system is fairly stable, in particular the largest institutions such as the G-SIBs. Of course, in many countries there's a weak tail of banks, but in the aggregate globally, the banking system looks pretty safe due to the high levels of capital. This is not to say that we won't see distress in some countries. It's just saying that in the aggregate, it looks good. So I think going forward, I mean, clearly, last year we already talked about low for long interest rates. Yield curves were already very flat and very low. And now yield curves are even lower, and they are lower even longer, right? So we are looking at a scenario where the market is certainly expecting, very low interest rates for a very long time, and where financial conditions such as credit spreads are starting to be fairly tight as well in certain segments. And that, of course, is an intended effect of monetary policy, right? Monetary policy acts by triggering risk-taking, by triggering lending. But the question is it also triggering excessive risk-taking in some corners? And this is where the perimeter of regulations is a key question. So I think we're very comfortable that banks are regulated in a way that ensures global financial stability. But in the non-bank financial sector, there are certainly areas where the regulatory perimeter cannot reach all of the corners. And so there is at some point a trade-off where easy financial conditions might be associated with some degree of excessive risk-taking or so. You know, of course, from an investor's point of view, right? I mean, you see low yields everywhere. The only way to generate income is by going into riskier and riskier segments. And that is an intended consequence of easier monetary policy, but only to the extent that it is not excessive. And so that is the balance that policymakers have to get right. And so we see vulnerabilities building in three main segments: the corporate sector that Eric discussed, the sovereign sector, which you know, is of course increasing debt to GDP quite dramatically, and then the financial sector. So those are the three sectors where risk-taking is happening. You know, sovereign debt is going up around the world. We published a longer time series of aggregate debt to GDP ratios of sovereign debt, and those are at historical high levels, right? Not surprisingly, that is intended. Of course, we want to support economic activity. We estimate that fiscal actions have been of the order of $12 trillion, right? So the expansion of fiscal policies has been of the order of $12 trillion this year alone, combined with $7.5 trillion in the G10 economies alone of central bank balance sheet expansions. These are very large amounts that have been deployed very aggressively. And in the medium term, the question is, how sustainable are these actions? So corporations are taking on more debt, sovereigns are taking on more debt, and the financial sector is incentivized to take on more risk due to, you know, expansionary monetary policy. So do we have that balance right in the medium term? And of course, in the medium term, the trade-off is that, you know, on the one hand, the economy might remain sluggish. So we expect that economic activity will remain substantially below pre-crisis trends, even by the end of 21 and even way into the medium term. So there might be deflationary pressures that continue, so that there's a continued bias towards easing monetary policy. So there's a continuous bias towards more risk-taking, towards more debt. And this is where these regulatory and financial stability issues are going to come in. And, you know, as Klaas has mentioned, you know, there's certainly an effort to look more into the prudential approach of the non-bank financial sector. And so to close my remarks, let me turn to asset valuations more broadly. So when we look at asset valuations, you know, they have returned, but they are stretched in some areas. And so the concern is not so much the asset prices per se, but it's the combination of stretched asset valuations and leverage that could lead to disorderly deleveraging cycles if bad shocks hit, either in the near term or in the medium term. So let me stop here.
Thank you, and thank you all three for interesting remarks along the line. Let me go back to and maybe start again with Eric on two things I'd like some additional comments on, Eric. You mentioned that there is a risk with current rates being so low, 0 to 25 basis points, and with the redefined objective under which the Fed looks at inflation, that rates could stay too low for too long, and that would entail a risk. Can you be a bit more specific where you see these risks? Do you see them primarily in the financial sphere? Adrian and Klaas were talking a lot about the risk-taking in the financial sector. What other channels are you concerned about when you look at that rates for too low for too long? And you know, I'll come back then with another question to the others.
Well, as Klaas highlighted, we've just come out of two kind of very severe outcomes. I would say going into the financial crisis, it was the household sector in the United States, particularly mortgage debt, that was challenging, and households were over-levered, and financial institutions did not have a sufficient capital buffer. So at that time, those are the two sectors that were unbalanced. This time, household sector was in much better shape in the United States, as Tobias has highlighted, so is the financial sector, or at least the banking sector. But unfortunately, the corporate sector was the sector, and I don't think we have models that exactly tell where the risk becomes excessive. What is excessive partly depends on the shock. So this is a shock that's hit particular corporations in a very severe way. So I highlighted the consumer discretionary sector, but not all restaurants, hotels, and retail are failing in the United States. It's really the ones that went into the situation in a much more precarious position before the shock occurred. So there was already secular changes that were occurring that was certainly disadvantaging retail, which is movement towards online. And in effect, what the pandemic did is compress that. Going forward, I don't know which of the sectors the excessive leverage is likely to occur. I would say in the United States, we don't have many tools, regardless of which of the sectors that it actually occurs in. I would also follow on Klaus's comments that the money market mutual fund sector was a sector that failed in the last crisis and failed in this sector, this crisis as well. So there are non-bank participants that are particularly problematic. And as Tobias highlighted, the movement in financial markets in March was clearly distressing. And I would say as the sovereigns grow very large, but brokerage balance sheets do not grow nearly as quickly, the ability to process extreme movements in volume becomes more and more difficult. So I would say our infrastructure needs an overhaul in markets. That's probably a topic for a completely different talk. But I do think there are a variety of areas that we still have financial fragility. And if we don't address it, I completely agree with Tobias's viewpoint that we've had to take very significant fiscal and monetary policy actions, but it becomes harder and harder to completely offset the shocks the more we allow the excessive risk to be building up and unbalanced in various sectors of the economy.
I mean, you mentioned rightly the money market mutual funds, and you also said that the U.S. was less prepared in activating counter-cyclical buffers. I mean, there are financial institutions and fund constructions that don't actually have any buffers built into them, and they've been at the core of the last crisis. They had some issues, and they had some issues now this time around. So do you see, and Klaus, you should come in on that. There's always the things we haven't done, and having been a regulator in the last financial crisis, the one area we knew is that we should have looked more in the re-regulation at activity-driven business. Whether you had movements of business credit origination, for example, that morphed from the core of the regulated industry, i.e. banks, to other non-bank entities, and there was some arbitrage and vulnerabilities building up, which were known, but really weren't at the core of regulation. Is it likely we're going to see more regulation around that class at the global level? So will the FSB focus on that? And Eric, is that something that the U.S. institutions and the regulators will focus on, this non-bank finance sector, sort of getting more into a rule-based bank-like environment in terms of regulation or in terms of resilience and buffer requirements? Maybe Klaus, we start with you on the FSB agenda, counter-cyclical buffer, and the whole discussion about those.
Well, I think the short answer, Axel, is yes, is affirmative. If we look back a few years, of course, I entirely agree with Eric that 10 years ago it was the consumers plus the banking sector. And then, of course, the financial reform agenda also focused heavily on the banking sector. It was heavily bank-centric. But then, as a logical consequence of that, there's always something like a waterbed effect. You push on one end, and then risks sort of migrate to other parts of the financial sector. We've been monitoring that within the FSB by having our so-called shadow banking reports that over time we started to rename non-bank financial intermediation reports. And there you could see the growth of NBFI intermediation. And the dark side of it is probably what we've seen in March, April, when these markets became very unwieldy, and that central bankers who traditionally always stepped in to backstop the banking sector now had to step in to also backstop all kinds of non-bank market activities. And clearly there will be a regulatory response to it. What we are doing currently within the FSB context is first come with what we call a holistic assessment of the events in March and April, so that we all start from the same page, from the same narrative as to what actually happened in March, April, what went wrong. Well, money market funds is clearly an area that is squarely within focus in that holistic review. We try to come to a better mapping of the interconnectedness that exists within NBFI markets, but also between NBFI markets and banking markets. And when we go into the Italian G20 presidency coming up next year, for sure, the question as to whether these markets have been adequately regulated will be on the table. And probably the answer will be that we have to have another look at regulation, and that we need to take systemic perspectives more into account, because traditionally these markets have been regulated from an investor protection perspective, which is an important goal of regulation as well. But there is more than investor protection, particularly in the interaction, and that is very high on the FSB's agenda.
Yeah, Eric, and then I'll move to Tobias with an add-on to this question.
Yeah, I'd say the money market situation is quite disturbing. The Boston Fed ran the AMLF in the financial crisis, and that was to address the run on the money market fund industry. And then again, this time, in the middle of a pandemic, I had to have employees in Boston, which was an epicenter, one of the epicenters of the pandemic, congregating in the Boston Fed and once again bailing out the money market liquidity issue. And so I'd say a couple things regarding money markets. One, the money markets, they're broadly two sectors. One is a sector that buys only sovereign debt in the United States, and the other is prime money market funds that have commercial paper, asset-backed commercial paper, municipal paper. It's the prime money market funds that were a problem. And coming out of the last crisis, the Federal Reserve presidents wrote op-ed pieces. We submitted a letter to the SEC. We're not the strongest of political forces, and we did not get the outcome that we were hoping coming out of the last crisis. As a result, the Securities and Exchange Commission put in a process that included things like gates, which actually encouraged people to run more quickly this time. So actually the actions taken last time made things worse, not better. So I think we need to really refocus on what assets are appropriate to have immediately available for individuals, and really think about the regulatory construct a little more carefully this time. I would highlight that this is a political process. And I think a lot of the issues last time were tied to the fact that money market funds have a strong lobby in the United States. They still have a strong lobby in the United States. So I think it is something that we should definitely focus on, but I wouldn't minimize how difficult it will be to do.
No, I agree. And Tobias, two issues you mentioned. First, you did say actually that emerging markets this time around, unlike in any other crisis, where actually some of them were able to hold or even lower rates going into the crisis, which you haven't mentioned, but I feel the role of the dollar and the dollar weakness has been a key factor why that was supported actually this time around. And so in a way, we had a lucky coincidence of a dollar weak development and emerging markets having a better crisis reaction, less costly to their domestic economies than would have otherwise been. But you face the same issues at the IMF when you talk about debt suspension, about who's on the other side of that table. Increasingly, it's no longer credit and banks that are the negotiating parties, but more than 50% of emerging market debt now is also in bonds, and there are other players around the table. So maybe describe a bit the challenges that you and the IMF face when it comes to these financial stability and issues around the counterparties in that.
Yeah, absolutely. So let me start by saying that emerging markets have been helped tremendously by the easiness of financial conditions. So, you know, when we were in the midst of the sell-off back in April, we imagined that many major emerging markets would come to the fund with requests for programs. And of course, we have provided a lot of financing to a lot of countries, but those were not typically proper programs, but rapid financing that are fairly small amounts. So they're about 1.5 times the quota that the countries pay in. They can get that, and there's no conditionality coming with it. But in terms of sort of like major emerging market coming for programs, we haven't seen that much, and that is really because they still have market access, right? So even riskier borrowers have market access, so that is tremendously helpful, and it is in a way positive spillovers of easy monetary policy by advanced economies. In terms of fiscal space, of course, emerging markets have less fiscal space than advanced economies, and low-income countries have even less fiscal space than emerging markets. So, as I said, you know, many advanced economies have triggered fiscal policies of the order of 10 to 15, sometimes even more percent of GDP. Emerging markets also have increased spending, but by much less, and then the low-income countries even less. And so the fund, along with the World Bank and other international institutions, have tried to help particularly the poorest countries in the world. So this is where the Debt Service Suspension Initiative, DSSI, comes in. So this was done by the IMF with the World Bank and with the backing of the G20. This is really aimed at the poorest countries in the world. So these are not emerging markets typically, these are low-income countries. And they have had some amount of debt relief as a result. I've just looked up, you know, the current number is about 40 countries have used that. And, you know, this is really to alleviate the debt burden for some time during this pandemic. Having said that, as you alluded to, you know, I would distinguish these low-income countries from the emerging markets. And the emerging markets have been able to deploy some fiscal firepower and have been able to ease monetary policy. And that's quite different from previous crises where, you know, the fear of inflationary pressures were a limit to how much they could do on monetary policy. So this time, because this is a very deflationary shock in commodities and in prices more broadly, there was quite a bit of space to lower. So emerging markets typically have depreciated vis-a-vis the dollar, but of course the dollar has depreciated vis-a-vis the advanced economies, and you know this goes to your point about the dollar strength. So there was risk off, and now risk on is back, and this is helping you know, countries around the world.
Yeah, and I think another lesson that I think all three of you to some degree flagged. Klaas, you were the most explicit on that. This time around, it was a concerted action between fiscal and monetary policy. And you three, with all your histories in central banks, the complaint last time around was that central banks were the only game in town, and every central banker felt he was put on the spot as being the only game in town. This time, fiscal policy played much more of a constructive role. But you mentioned the elephant in the room, Klaas, and that is structural policies. We've heard when President Trump came in that there was a promise of a large infrastructure program that initially was fantasized by markets. It never happened. There's been a European discussion around structural policies for as long as I remember. And, you know, the funds we've dedicated, yes, there was some institutions set up, but it hasn't happened. What makes you optimistic that the support that central banks have provided this time around, if and when we get to the other side, as Eric said, but we need to get there. But once we get there, what makes you hopeful that monetary policy and fiscal policy will get a helping hand from structural policies?
Well, that's a difficult question, of course, because we know that for structural policies, there's always a lot of political obstacles that need to be overcome. Usually structural policies are a nice way of finding policies in the sort of general interest, but unfortunately at the expense of some partial interests that are typically that know typically to organize themselves quite well in democracies like ours. But I would simply say that at the end of the day, we'll end this pandemic emergency phase with much, much higher debt levels than we entered it. We even, you could say that we probably are going to exit it with debt levels that were unprecedented in peacetime. We've only seen such debt levels before in war, after wars, etc., but never in peacetime. Now, if you think about ways to bring back debt to GDP ratios, most solutions are quite bad and have a lot of side effects. There's only one healthy solution, that's making sure you create more nominal growth, nominal GDP growth. Well, I mean, we're all working towards sort of bringing inflation back to our aim. That's one part of the equation. But by far, the most important part of the equation needs to be real GDP growth. And real GDP growth with sort of the demographics that are ahead of us, where Europe is roughly lagging Japan by 15 years or so. The main source that can create real GDP growth will be productivity growth. And that's I think the only viable way forward to get out of this situation. And therefore, at some point, we will have to arrive at that option, because all the other options are way more painful. I mean, when you talk about debt restructuring, when you talk about inflating away the debt, even if you think that that would be possible, by the way, but these are all have heavy sort of drawbacks. So I think we have no choice, but we will have to go there.
Yeah. What role does digitalization of our economies play in boosting productivity? I mean, we have just seen in major, in our operations as banks, people work remote, people work from home. Productivity has actually increased quite sizably in the financial sector over the last half year and continues to do so. So is technology and digitalization, are those factors that will play a bigger role? And, Eric, you mentioned that there are some sectors that are less affected or, even performing well. You mentioned services, but within services, there is a bifurcation quite strongly between some of these technology players who've really seen a bummer year so far, and others in services that are more stationary services, like restaurants, hotels, and all of that, where you basically have problems. The US is home to many of these tech companies. Where do you think the journey will go and what their contribution to productivity progress will be?
Well, I think they are an important source of productivity. If you had told us that we would be working remotely for 9 months and still be running our organizations as well as we have, I think most people would be skeptical. So I've actually been quite surprised how efficient my own organization has been and other organizations have been in an environment where people are basically working from their homes. So that clearly wouldn't have been something that would have been possible 10 or 15 years ago. It is now possible now. And it's in part possible because of the innovations that we're seeing in digitization and technology. So I think that is going to be an important source of the productivity that Klaus is talking about. But I think people are always going to still want services. So people are going to want to be able to go to a restaurant. People are going to want to be able to take vacations. People are going to want to be able to stay in hotels. So a full recovery actually requires us to get the public health situation to the point where some of those services that people desire to do. I mean, I haven't been inside a restaurant since March. That's not my preference. So my guess is that's not anybody's preference. And so I think there's a lot that you can do with technology, but there's a lot you also want to do without technology. And one of those things is actually productivity enhancing of just getting informally together with people. So a Zoom meeting like what we're having now, I think is quite effective in talking in general. But if you think about productivity in terms of a clash of ideas where better ideas come out, I would say this technology is still a little clunky. And there's no substitute for having a beer with a few people or having a cup of coffee with a few people and having those informal discussions. So I think we're a long way away from avoiding kind of the interpersonal connections that sometimes bring the most fruitful outcomes.
Right. One additional area that you both mentioned is you mentioned Klaus again spoke about liquidity problems becoming solvency problems. I think that's the real challenge that lies ahead. that we will see. And to some degree, whether we get there or not, as Eric put it, depends on policies that are being displaced. And how we get there is past dependent, if I put words in your mouth about the fiscal and monetary policy response. Where do you see the rating agencies? It's another feature of the last financial crisis where basically pro-cyclical downgrades and when people look at leverage have played a role in creating the dynamics that we've seen. Is that a risk? I read a report that 24 sovereigns have been downgraded over the last couple of 6 months. There's another up to 25 under review. So there could be a major wave of downgrades, and these downgrades with credit provisionings being to some degree, pro-cyclical by nature. Do you see that as a major risk going ahead, that rating agencies and downgrades of sovereigns to non-investment grade play a major role, both I think for you in Europe and in the US, and for Tobias sort of in emerging market space? If you keep the least developed countries and the most vulnerable countries aside, I think there it's pretty clear they often don't have ratings. But do you see that as something we need to look out for in terms of an amplification of where we are in terms of crisis?
If you start with me, Tobias,
go ahead,
first,
Klaus. Sorry, I don't know. Axel, did you want me or Klaus?
Yeah, Tobias, why don't you start from an emerging market?
Yeah, absolutely. I can start. On the one hand, of course, when you have this major adverse shock, right, you would expect some downgrades, right? I mean, it's very natural, right? We didn't know that we would have this major shock, and clearly this is not going to go away entirely, right? We will not end up in the same situation that we left back in January once we are out of this crisis, right? As we are going through this, there are structural changes in the structure of the economy, in the composition of the corporate sector that are either accelerated or where consumer behaviors change to some degree. So, while productive capacity might go back to pre-crisis levels, the composition of how that looks might be quite different. And so that means that we need to have some degree of adjustment. Corporations need to be restructured. Some might have to be recapitalized. I mean, we have seen many countries rolling out help to small and medium-sized enterprises that might not have access to capital markets to raise capital. And of course, some corporations might have to be resolved. Credit rating agencies play a crucial role in terms of assessing credit risk, and we all use them, investors use them, but also regulators to some degree use them. So yes, there should be some degree of downgrades, but is it excessive? I think that is one question that is certainly on the table. Some argue that is the case. And secondly, is the reliance on the ratings, so is the usage of the ratings somehow exacerbating pre-existing vulnerabilities? And there, of course, the wedge between investment grade and sub-investment grade has this cliff edge. As you know, the vast majority of corporations issued just one notch above in sub-investment grade in recent years. And so there's a risk that you just drop off. And, many pension funds, insurance companies, and asset managers have a discrete change in behavior around that level. And so that could potentially exacerbate a downward trend.
And it's something we saw in the last crisis, and there were ample of warnings for maybe taking it away. It hasn't disappeared, as Eric said. Not everyone that lobbied for a change there was successful. So it's a vulnerability we still face. So Klaus or Eric, do you see that also for sort of, even the Federal Reserve had to intervene in a threshold in the US bond market and, securing also the credit markets in the week of March 16th in a very bold move that was unprecedented. Do you see those cliff edge problems as something that we need to sort of, focus on going forward as the situation becomes more tense again with the pandemic increasing again?
So I'll do the United States and then let Klaus do Europe. In the United States, as Tobias highlighted, a lot of firms issued just above below investment grade. So that is a challenge because it means a lot of corporations went in more levered than might have been desirable. But I would say the biggest risks, I would say, are in the banking, the smaller business, medium-sized businesses that don't have access to capital markets. So the ability to refinance in the United States, if you're a reasonably secure firm, I think the actions that the Federal Reserve has taken has given you a huge opportunity to lock in low interest rates for a long period of time. But if you're a bank-dependent firm, Tobias and I were talking about the survey of lending, and credit conditions have tightened. And so we haven't seen insolvency of banks, but we have seen many banks in the United States tightening their credit standards quite abruptly. And how do you think about a financial stability risk? Well, it's a cutback in loan supply that changes the lending conditions that make it much harder to be able to recover. So a couple things to consider. One is the length of this pandemic. No firm can last forever without being able to get sufficient revenue. And that's not a leverage issue, that's a public health issue about how do we contain the virus, how quickly can we get the vaccine deployed. But even if we do it relatively quickly, I think there are going to be a large number of firms that are going to have great difficulty surviving. Just getting through the next 3 months without cash flow for many organizations is going to be very difficult. I would think it would be disproportionately small and medium-sized businesses, and then some very large businesses that are very focused on things like hotels, transportation, those areas. But will it be a broad bond market problem? My hope is it certainly isn't, but I think it is partly path dependent, as you highlighted, depending on what happens with the pandemic.
And Klaus, with Europe, with its more bank-based system and therefore corporates more dependent on credit, how do you see that play out? You also mentioned that the ECB will recalibrate some of its programs that all work, or except the pandemic purchase program, works through the credit channel, through bank channels. So how do you see the situation in Europe evolve as we speak?
Well, first of all, even if we are more bank oriented, of course, the interventions in March that also took place in the corporate bond markets, commercial paper markets, etc., they were, of course, also meant to avoid these cliff edge effects that would otherwise have given rise to a very negative dynamic. But indeed, I would say also in Europe, of more importance is actually keeping bank credit flowing to SMEs, and that's why we have this TLTRO instrument that we've already deployed several times before, and that is generally be seen very favorable in the governing council because it appears to work. It appears to keep credit flowing at the time in which this is vastly important, and it will continue to be important as some of these issues in the corporate sector will still have to manifest themselves. At this moment in time, I mean, there are moratoria, there are government guarantees, etc. But the famous saying is that only if the tide retreats, you will see who swims naked. Well, that is also still true for corporates and particularly for the SMEs. Now, on the ratings, I think one aspect that I think is also relevant to consider in the European context is, of course, the issue of sovereign ratings. That has also plagued us a lot in the previous crisis. Thus far, I must say, we have not seen sort of these destabilizing rating downgrades. In our setup of PEPP, I think we anticipated some of that, or at least we had these downgrades happened. We already anticipated taking measures in the collateral sphere, but also in the sort of qualifying measures, the qualifying criteria for purchases, where also below investment grade purchases were possible, etc. So we would have been ready had it happened. Fortunately, it hasn't happened. And I think one of the reasons why it hasn't happened also is this next generation EU recovery fund, which has been a clear demonstration to the markets that Europe is actually united, that the central bank is standing behind the sovereigns, and that has also been a factor why rating agencies have looked much more favorably to individual sovereign ratings as well, so that these sort of negative spiral effects have not occurred so far.
Right. And probably the audience, given that we're drawing closer to the end, would not forgive me if I don't ask you for some outlook on your monetary policy actions. And Klaas, since we have you just had the word, you mentioned there will be a recalibration. You also mentioned all the elements there. The primary focus will be the flow of credit. Could you allude a bit what sort of the discussions around how you will recalibrate the use of these instruments, because pandemic has increased, case numbers are going up. There's a clear indication that with the lockdowns there will be another impact. The situation is more severe than it was over the summer. So what are we likely to expect in December, given that Christine has alluded to the market that there will be a holistic review of all of these programs, and you indicated it will be also along the line of are these programs geared to maintaining financial conditions as easy as they might have been now and have tightened recently? So maybe you can give us a glance of how you will debate the structure of the debate rather than the outcome.
Yeah, well, I mean, I think it's good to keep in mind that, of course, with all these unconventional monetary policy instruments in place as well, that monetary policy is no longer a one-dimensional activity. In the old days, you either lowered or you increased rates. And if you needed to do more, you did more in the same dimension and in the same direction. Whereas now we have a whole mix of instruments active: forward guidance, negative rates, TLTROs, asset purchases. So recalibration clearly means that we will have another look at where we are today, which is of course different from where we were in March, April, when sort of the last major recalibration of our total package of measures was undertaken. But we will do that against the background of having a second wave, which at least in the short term will imply renewed uncertainty and sort of a downward impact probably on the fourth quarter as a minimum. Now, since of course we also now have this news on the vaccine, we will have to digest what that will imply for the outlook. If, and this is a if not only the development of the vaccine, but also the distribution and the deployment were to go smoothly, then of course, then that would reduce uncertainty. It would not immediately change the outlook. The outlook in 2021 will still be affected by what's happening now with respect to the virus, etc. But at least it would allow us to have an endpoint. There would be light at the end of the tunnel. You would have an idea of when roughly the emergency were to end. And then of course, you could also use that information to calibrate backwards to today. Where do you want policy to be when the emergency is over? What will we have to overcome in the meantime? And for that, I would say it's only, I think, a blessing that we have a multi-dimensional monetary policy mix at this moment, which allows us to finally calibrate all the individual instruments to be as effective as possible, but also to be as efficient as possible. Because I already mentioned, we're not totally unconstrained. Monetary policy was already stretched going into the Corona crisis.
Yeah, and Eric, you mentioned before the bold intervention by the Fed to put a floor in the bond and credit market. The PPP program on another angle of the US markets has also worked pretty well. You mentioned the Main Street program, which is that middle layer that over sort of recent months, we've seen that there was some issues around whether credit gets to all parts of the US corporate sector. And there were some recent changes on that. Maybe you can put a bit into perspective what those recent changes will do to the Main Street program and how that will affect your monetary policy and what the general outlook is. I know you're not thinking about increasing rates, but I'm sure some of these designs of these programs must be discussed in the next meeting as well.
So the Main Street program, the big innovation was to lower the minimum loan amount to 100,000. So it does make it possible to give loans to smaller businesses than we were able to before. I would say the program actually has a fair amount of legal overhead. And so in order to be able to be fully effective, banks probably need some certainty as to how long the program will be in existence. Currently, all the 13.3 facilities, or most of the 13.3 facilities, are going to sunset at the end of this quarter. So one of the questions is going to be whether the facilities are extended or not. That's a decision that the Treasury Secretary and the Board of Governors have to decide jointly. So I think that's an important juncture. A second thing I would highlight in terms of policy uncertainty is that while we have a president-elect, not everybody agrees on who the president-elect is. And while we've had Senate races, it's still a little unclear what the Senate composition is going to be. And depending on how all those decisions get rolled out, makes a big difference to what kind of fiscal policy package, if any, we'll see in the coming months. So I think if you go back to the previous summary of economic projections that the Federal Reserve did, there was an expectation both that we wouldn't have a second wave in the pandemic and we would have fiscal policy. And both of those turned out to be wrong assumptions. So I think the next 6 months are still pretty challenging. We'll have to be thinking about that. And as Klaus has highlighted, depending on how well the vaccine works and rolls out and how well it's accepted by the population, can have a big impact on how quickly the economy can be normalized.
Yeah, absolutely. Tobias, one of the things that I think we had recently discussed at the G20 meetings and at the IMF meetings, which just happened over the last few weeks, is the DSSI program that you talked about. What is your expectation sort of, I know that we're also having private sector involvement discussion at this point in time. The IF is actively involved in these discussions. Where do you think this will land, and what is your outlook for the global policy stance? What we will see. Will there be additional measures that you expect from mature markets, fiscal policy? Eric mentioned some of the idiosyncrasies around the U.S. policy setup, but that is unclear after the election still. Europe, you expect more there, and what can we expect emerging markets to contribute to global growth? Because you're the organization that sort of helps coordinate all of that.
Yeah, absolutely. So let me start with the debt issues. So the investor base for sovereign debt has changed dramatically over the past 20 or 30 years. We moved, London Club and Paris Club used to capture all the investors, and today, of course, lenders are much more dispersed. I think one of the key objectives going forward has to be transparency. It has to be visible to investors what the debts of countries are. If we don't get there, it's going to be difficult going forward. So transparency is key, and then of course, finding efficient market-based solutions for debt restructuring is going to be key. We've seen two this year, and there will certainly be more coming. But we don't see a systemic debt crisis as the central scenario at the moment. I think there will be lots of restructurings because there are many countries in need, but it's not the kind of global debt crisis at this point that I'm worried about. Secondly, in terms of fiscal policy, I think a key takeaway from what we're seeing so far is that there are huge differential effects within countries and across countries, right? The population that is hit hardest are low-wage earners. And so you see poverty going up, you see income dispersion going up, and those are not issues that can be solved with monetary policy. You really need fiscal tools to address that. And of course, across countries, some countries have rebounded nearly all the way already. Others are on path to get there, but there will be many countries that will be left behind. And so you will see this huge disparity going forward. I think that will be a theme and the challenge going forward. And then let me make a last point, which is about monetary policy going forward, right? I mean, in monetary economics, people often talk about R-star, so like the equilibrium interest rate, right? Of course, central banks determine where the market interest rates are, but there's some notion of what is the equilibrium in the absence of monetary policy. And that is, of course, determined by fundamental factors, the aging of the society, the productivity growth, which has kept slowing down, and this kind of preference for safe assets. So all of these are pressures to further keep interest rates low. And so, you might see that at some point, a neutral stance of monetary policy is at very low interest rates, right? I mean, the Fed was neutral at 2 or 2.5%, right? It used to be neutral at 4.5%, and earlier it was neutral at 6.5% or so. So you have seen this notion of neutral coming lower and lower, and that will certainly be a theme going forward. So even if we're somewhere close to full capacity, we might still see these very low interest rates. And from an investment point of view, of course, that's a huge challenge.
Okay, one last, and I think we just got time for a last very quick round. All of you mentioned, and also being chairman of a bank, I appreciate that all of you said this time around the banks haven't been part of the problem. And actually, I would add that we could, through a very targeted way of dispensing credit in our home market in Switzerland, be part of the solution in bringing money quickly to where it was most needed with the clients. Going forward, in terms of the banking regulation and where banks in general are, there is, of course, the absurdity that if you are a de-risked bank at the moment, you might benefit from that situation in a period where the risks are off. But as soon as the market sees some glimpse of hope, like the vaccination yesterday, there is a risk rally. And where do you see market volatility? Do you see that as a lingering phenomenon that we need to get used to, that we have these on and off rallies and booms and busts happening, in an order of magnitude that we're just not used to in the markets? Despite general low volatility, will we continue to see sort of these on-off markets? And then I will take that up with my investment advisors in the later panel to really talk about what we should do out of that. So maybe just in reverse order, starting with Tobias and then Fast, and we should close within the next 5 minutes.
Yeah, absolutely. I think the banks are much safer, but there's this concern. So far, bank credit has expanded very quickly, and banks have helped to sustain economic activity. But of course, in Europe, marketable ratios are very low, so there's a pressure from consolidation. And we see already in these surveys of senior loan officers in both the euro area and the US that banks might want to tighten underwriting. And this is not because they don't have enough capital, but it's because they don't like what they're seeing out there in the economy, right? I mean, there's just a tremendous amount of uncertainty out there. So I think this will be a continuous challenge. In terms of the risk on, risk off cycle, I mean, now we're in a world where, asset purchases are everywhere. And this is pushing up asset prices. That is the transmission channel. But of course, it might mean that you have these temporary sell-offs. And then the question is, are the central banks going to come in each time? And, it's questionable. So I think that will be fascinating to see going forward. But I would be surprised if central banks, so at the moment, of course, they want to get through the pandemic. But once the pandemic is over, how much support do you give to the market? I think that's a big question.
Absolutely. Klaas.
Yeah, well, Tobias stole my thunder on at least one of the points that I wanted to make. As long as there's this vast amount of QE around in the markets, I think, and interest rates will be so low that every minimal change in interest rates immediately has huge impacts on discounted cash flow valuations, etc. I think there will be volatility. But on the banking side, just one drop of cold water. I mean, banks have held up very well. The financial reform agenda with respect to banks generally has been a success because of much higher capital levels. But not all is well. I think there are still questions as to the relation between minimum requirements and usable buffers, where we went into the crisis where we wanted to use buffers, and we actually found out that despite what Eric was saying on Europe, also in Europe, the amount of counter-cyclical buffers that we had was way too limited in order to make a meaningful dent to really provide some relief to the bank. So what we ended up doing was providing relief not only by releasing that little bit of counter-cyclical buffer what was there, but all kinds of things which we previously called minimum requirements, which we quickly now call buffers, and then we released them. But then we came in a stage in which the banks were unwilling, or at least reluctant, to really use these buffers, because also these banks, of course, understood that not so long ago we thought that these were minimum requirements and not usable buffer. So I think also after the crisis, we will have to come back to the question, what is the optimal mix between hard minimum requirements and usable buffers? And particularly the countercyclical buffer, also in Europe, needs to be much more prominent, so that we can have easier sort of buffer relief efforts without touching on the credibility question each time.
And just as a just as a reaction directly, we did have a countercyclical buffer in Switzerland of 2% that was released and used for some of these programs. But of course, as Eric mentioned before, the time horizon on some of these reliefs is very important. If it's only until the end of the quarter, it's very hard to eat into these buffers if you have to replenish them sort of on the back end of using them as well. So I think that the time horizon, and this is why we always report figures basically without any regulatory forbearance, because that's really the look-through you need to do in this current quite risky environment. But Eric, your view on this last issue?
I think it's a great question, Axel. I'm worried that the volatility cycles will get worse if we don't take financial stability quite seriously. So as Tobias highlighted, we're in a low R-star environment, which means even if we are able to normalize, we're going to normalize at low interest rates, which means in recessions, we're going to hit zero frequently. And then on fiscal policy, as Klaus has highlighted, the debt to GDP ratio is at where we were coming out of World War II. That means we just don't have the same flexibility. We don't have monetary policy space, and in many countries, we won't have fiscal space. So I think we have to be concerned about not taking the volatility issue more seriously going forward. And my final comment would be, it's much easier for central banks to intervene in markets than it is for smaller and medium-sized firms and households. And that starts to create a bigger and bigger distortion. So if we have tail events pretty frequently, and the way we react to that is to have programs that help large investment grade firms, but don't help small firms and don't help individuals, you start getting into a situation where you worry about the sustainability, both in a political environment for democratic society, and also the income inequality issues that come out of that. So I think we need to take the financial stability risks and the volatility quite seriously.
I agree with that. And with that, let me thank all three of you for being available for this panel. As in the last 10 years, the Monetary Policy Maker panel has been a prominent spot on the program. So thanks to all three of you. And again, just from my side, I appreciate all that the central banks have done. And I appreciate the role of the IMF in coordinating the global response on the crisis. So gentlemen, it's been a real pleasure that you joined the call. And on behalf of UBS, I want to thank you all. And I look forward then to next year's 11th conference, hopefully then again in physical, but it's not a conviction call. Thank you.